Markets are in panic mode, and for a good reason. The US government is finally over, but only temporarily. Political uncertainty is still hanging over Wall Street. Key economic data is missing too. Last week's CPI report didn't come out. December's rate cut odds have now dropped from 63% to 44%. The fear and greed index is in extreme fear at 22. Even the VIX spiked to 23, signaling more market volatility ahead. Bitcoin hasn't escaped the pressure either. It's now back below 100,000 as liquidity tightens. So, question is, what is really going on? Why aren't the markets coming down even after the government reopened? What's good, YouTube? Julian here, and today we're going to be breaking down the markets, the Fed, crypto, and what it means for your portfolio. So let's dive right in.
Now, if you like videos like this, I'm going to give you 5 seconds. Help me out by clicking subscribe and also commenting more so that I can produce more videos like this for you guys. 5, 4, 3, 2, 1. Without further ado, let's get back into the video.
Now, let's talk about the biggest headline for this week. Yes, the government shutdown is now over, but only temporarily. Congress passed a stopgap spending bill that funds the government until the end of January 2026. This means that nothing is actually resolved. It's just a short extension just to buy time. The core dispute that triggered the longest shutdown in US history is still there. The fight is over healthcare insurance subsidies for about 24 million Americans under the Affordable Care Act. These subsidies expire at the end of this year, and the Trump administration has already said that they do not plan to renew them. Democrats want the subsidies extended, but Republicans want them removed. That disagreement hasn't moved an inch. So once we reach January 30th, 2026, if both sides still refuse to compromise, we possibly could see another shutdown. And this kind of political uncertainty is the last thing that the markets want right now. Investors can process bad news, but uncertainty makes everyone nervous. It delays data, disrupts agencies like the Bureau of Labor Statistics, and creates blind spots in the economic picture. So even though the government technically reopened, the underlying risk is still there. Nothing fundamental has changed, and that's why the markets didn't recover. If anything, the reopening just highlights how unstable the situation is. Now, let's talk about what's actually fueling the panic: the data blackout. So even after the government reopened, last week's CPI report is still unlikely to be released. And this isn't just an inconvenience. It creates a huge information vacuum for the entire market because the CPI isn't just another report. It's numbers that the Federal Reserve relies on to decide on whether to cut rates or keep them higher for longer. And without the data, the Federal Reserve is flying blind. Institutions are flying blind. Traders are also flying blind. Sentiment is also falling off a cliff. The fear and greed index has dropped to 22, putting us in extreme fear territory. And on top of that, the volatility index, VIX, has spiked up to 23 on Friday, signaling that volatility and investor anxiety are both rising fast. Historically, once the VIX breaks above 20, markets often enter a recalibration phase, a sign that uncertainty is fully taking over. And with the markets just ready to react, last week, December rate cuts expectation was sitting at 63%. Now they've collapsed to 44%. So let's talk about the big question that everyone is asking. What happens if the Federal Reserve doesn't cut rates in December? Because right now, with the CPI delay, the shutdown backlog, volatility spiking, the market is starting to price in a very real possibility. No cut, no pivot, nothing at all. And if that happens, here's what we can expect. The borrowing costs stay painfully high. No cut means yields stay elevated, and that impacts everything: mortgages, credit, business loans, corporate debt rollovers. It slows momentum heading into the first quarter of 2026, right when investors were expecting relief. Higher interest rates also don't just affect the economy, they hit the stocks harder than others. tech and growth companies are most sensitive because their valuations are based on future earnings. The higher the interest rates go, the more those future profits are discounted, and that pushes prices down. Small cap companies feel it too. They usually borrow to grow more and have less cash on hand, so higher borrowing costs can really squeeze them. Basically, anything that relies on financing or future growth takes the first hit when rates stay high. That is why investors rotate towards safer cash generating stocks in this environment. Now, a stronger dollar sounds like a good plan until you realize that it tightens global conditions. It pushes commodities down, weakens emerging markets, and creates a flight to safety environment. Risk assets struggle in that setup. You also notice that crypto loses its liquidity tailwind. Bitcoin dropping to below 100,000 isn't random. It is tied to expectations because crypto usually performs best when liquidity expands, interest rates fall, and the dollar weakens. And if December turns into a no cut month, that liquidity cycle can get pushed back. Now, let's talk a little bit about the aftermath of the shutdown. So, even though the shutdown is now over, it may take weeks for federal workers to receive back pay and for benefits recipients to get their payments. The economic data release calendar is also behind, although we stand a good chance of seeing the long delayed September jobs report next week. Early indications from the ISM employment indicators and ADP private payroll suggest that this is likely to be soft. We will also be getting the minutes from the Federal Reserve's October FOMC meeting, expecting the results to be hawkish. And this reflects Chairman Jerome Powell's comments that the December rate cut is far from guaranteed. All these feeds directly into the market's current state: uncertainty, elevated volatility, and cautious positioning. And now the Federal Reserve has a very difficult decision to make. To move confidently, they need clean data and they need it fast. So hopefully agencies can now catch up, the reporting backlog clears quickly, and the Federal Reserve gets the numbers that they need before the window closes. Now let's talk about crypto because this is where the fear really shows. Bitcoin slipping back under the $100,000 range isn't just a price move, it is a sentiment shift. And when rate cut hopes drop, liquidity expectations drop with them. And crypto is often the first asset class to feel that tightening long before equities react. Now, Bitcoin isn't crashing, it's simply repricing based on the new reality. No guaranteed rate cuts in December, higher yields for longer, a stronger dollar, and a more cautious market. And when liquidity rotates out of risk assets, Bitcoin is always the first to react. So recently, we noticed that Bitcoin fell to about 95,885, which is its lowest since May 2025. Ethereum also dropped to a 10-day low of 3,175. And since October 7th, the total crypto market cap has dropped roughly $1 trillion or 24%. Massive ETF outflows hit the market around $870 million in a single day, showing that even institutional investors are now pulling back. And at the same time, there are still some smaller inflows. According to Cointelegraph, Bitcoin spot ETF saw $1.2 million in inflows on November 10, indicating that there are still some institutional interest remaining. But the big picture is clear. Capital is cautious, risk appetite is low, but not completely gone. Long-term holders have also sold over 815,000 Bitcoins in the past 30 days, which is one of the largest volume since January 2024, which is now pushing Bitcoin into a bear market territory. So here's what I see in the charts. So here's what I see for Bitcoin. As you can see right here, Bitcoin has broken past the 100,000 level, which is not a very good sign for Bitcoin. But however, it is right now at another key level, and I would say 95,000 in this range. And for Bitcoin to continue its way up, it has to respect this level of support, because if Bitcoin does not do that, it has a chance of breaking past this level of support, heading down to the 85 to 80,000 range. And this would be one of the next key levels that I'm looking at for Bitcoin. But if it does recover, pushing back up, I would say that it still does have a lot of resistance to go through in order to really break out and reach back to its all-time highs. With the first one over here, this is one of the key areas that it needs to break before it can continue higher, reaching to its all-time high. So this is what I see right now. Bitcoin still has a lot of reasons to go down, but I would say that the fundamentals still remain strong. Why do I say that? Because this is what most retail investors miss. The long-term fundamentals for Bitcoin have yet to change. Adoption is still rising. We still see more wallets, more users, and payment integrations coming in. We still see institutional demand remains, which is evidenced by ongoing ETF inflows. We still see that the network activity is still stable, which still shows continued real-world usage. So personally, I think that this pullback that Bitcoin is having is macro driven and it's not structural. It's the market recalibrating to a tighter liquidity environment, higher yields and risk off sentiment. And once clarity resumes with the CPI data, with the Federal Reserves giving renewed confidence in the markets, I believe that crypto would recover faster than equities because the fundamental story is still intact. So far, we've looked at how macro uncertainty and liquidity pressures are hitting crypto. But Bitcoin isn't the only market reacting to this environment. Stocks are also feeling the heat, especially broad indices like SPY and the tech-heavy Magnificent 7. So if you are a trader or investor, the price action in these charts would tell a story just as important as Bitcoin's pullback. So let's open up the charts and break down what's happening exactly so you can see for yourself. So here's what happened to SPY last week. SPY had a push up from this level of support. However, within the last 2 days, it actually created a push to the downside. But the good news is this, on Friday, even though it started off the Friday as a red bearish candle, however, last minute, just as the day ended, it did a very nice push up back into this level of support. And for the coming week ahead, I want to see that this level of support gets respected, because if it gets respected, then we can see SPY continues moving up. However, if it does not, SPY does have a very huge chance of coming down to this level of support right here. So these are some of the key areas that you want to pay attention to what's happening for SPY. Next, let's look at Microsoft. And as you can see, Microsoft also was in the same boat as the SPY in general. You can see that last week, Microsoft was playing mostly sideways within this level of support right here. The good news is that it ended up on Friday with a very large bullish candle. And this is a good sign for Microsoft because this shows that Microsoft does have the intention of wanting to go up since this level of support was respected. So I do expect in the coming week that Microsoft will head back up to this level of resistance before deciding on what to do. Now, looking at Amazon, it doesn't look too good because after the nice push up on Amazon, Amazon decided to actually break past this level of support back down to this level of support right here. So what I see for Amazon is that it's probably going to move sideways until it decides on whether to break out from this resistance to continue its movement higher or break down the support to continue its movement downwards. But Amazon is still relatively good company in terms of its fundamentals. So if you're holding Amazon, just do take note of this price action and these key levels so that you know what to expect next. Next, let's look at Google. Google also was spending its time playing within this area. On Friday, it actually dipped down to this level of support. However, it ended up the week strong in a very nice bullish candle on Friday, which again is a good sign for Google holders. Also, it is also reported that Warren Buffett or Berkshire Hathaway did have an investment in Google as well. So this is likely good news for Google investors, because if someone like Warren Buffett did show interest in Google, this means that the general retail will actually also look at this in a positive sentiment. So I do see that Google has a chance to push up even further after this news. Next, let's look at Apple. Apple is another company that was sideways throughout the week, which is actually a pretty good news, because Apple does show that it has strong bullish pressure in order to want to continue its way up. Right here, you can see that it's right now playing within this level of support and resistance, and it needs to decide on whether to break this resistance in order to continue its way up, or break down below this level of support to continue its way down. If it doesn't, it's probably going to continue moving sideways until it can actually decide on what to do. So keep an eye on these two key levels if you are holding Apple. Next, let's take a look at Nvidia. And as you can see, Nvidia also was moving sideways along this level of support and resistance. On Friday, it ended up the week strong in a very nice bullish candle, which does give us a little bit more confidence in Nvidia. And this is actually good news, because as long as Nvidia is playing within this level of support and resistance, it can still make a decision on whether to break above to go up, or break below this level of support to continue its way down. I'm looking more towards Nvidia pushing up because of this strong bullish candle, but we shall see what's going to happen to Nvidia. Also, do take note that Nvidia earnings would be coming up really, really soon as well, 19th of November, which is effectively in the coming week. So the earnings will give the investors an idea of the sentiment as well. So do take a look out if you are holding Nvidia. Lastly, we have Tesla, which has broken through this level of support, heading down to the next level of support. So let's see if Tesla is able to hold at this support right here, because if it does, then it has a potential of climbing back up. But if it doesn't, and it breaks through the support, we can see Tesla likely to go down even further. So just take note of these key levels if you are an investor in Tesla. Next, I want to look at AMD, which is a company that some of you have requested for my previous video. And just a reminder, if there are any companies that you guys want me to go through, just let me know in the comments and I will look at it in the next video. So here's AMD, and as you can see right here, AMD is still playing sideways between this level of support and resistance, which it needs to decide on what it wants to do. If it wants to go up, it has to break above this level of resistance right here. But if it breaks below this level of support, then it will actually go down. So take note, those of you who are holding AMD, because these are the key levels that you want to pay attention to. Now let's take a look at what's happening to gold. So right here, after a long sideways movement last week, gold actually decided to break out and move to the upside. It was a massive push to the outside. So what I can see right now is that this area here, which was formerly a lower low and a lower high, right now this area has already been broken, creating right now a higher high. And this shift in market structure tells me that gold does want to push up. Even though on Friday and Thursday it was actually having a retracement down, however, I still see that gold right now has a huge potential to push up even further, since it's respecting this area right here. So these are the key levels that I'm looking out for gold. This area here is going to be the last support for gold, because if gold breaks through this level of support, gold is likely going to go down. But as long as this level of support is being respected, gold has a chance to go and continue its movement upwards. So this is what I want to see from gold. But right now, as of this coming week, I foresee that gold still has a potential to continue its movement upwards, because the market structure still shows that this higher high and right now creating higher low is still being respected. So if gold wants to continue moving upwards, I would like to see a push above this level of resistance, heading up to this level of resistance, which is the all-time high. And this area here would be the final deciding factor on what's going to happen to gold. If gold does respect this area of resistance, it will head down. But if gold does have a strong push to the upside, it's likely going to continue upwards. And looking at the uncertainty, I would say that right now gold has a huge upside potential, but we shall see what's going to happen. So there you go. Here's the current market picture. The shutdown's over, but uncertainty still remains. Whatever it is, stay informed, stay disciplined, and ride the volatility smartly. Now, if you found this video to be helpful, help me out by hitting the like button, subscribe, and if you want to see how a simple trading strategy makes me $1,000 days consistently, then click the video around this, and I look forward to seeing you in the next video. Bye bye.